Hello and good morning. My name is Dhruv P. Bhansali, and today I will be presenting amalgamation and related provisions. An amalgamation is combination of two or more companies into a new entity. Amalgamation is distinct from a merger because neither company involved survives as a legal entity. Instead, a completely new entity is formed to house the combined assets and liabilities of both the companies. The transferor company is absorbed into a stronger transferee company, leading to a new entity with a stronger customer base and more assets. The companies going into liquidation or merged companies are called vendor or transferor companies. The new company, which is formed to take over the liquidated companies or the company with which the transferor company is merged, is called the transferee company. Amalgamation can help increase cash resources, eliminate competition, and save companies on taxes. The process of M&A or amalgamation typically involves due diligence, negotiations, obtaining approvals from regulatory authorities, and filling other legal requirements. The Reserve Bank of India has also given certain regulations for merger and acquisitions in sectors such as banking and insurance. Additionally, the Competition Commission of India reviews these transactions to ensure that they do not lead to significant adverse effect on competition in the relevant market. But it can lead to monopoly if too much competition is cut out, scale down the workforce, and can increase the new entity's debt load. So the types of amalgamations. Under the Indian law, there are two types of amalgamations, horizontal and vertical. Horizontal amalgamation involves the merging of two companies of the same industry, while vertical amalgamation involves the merger of different companies from different industries. Also, other types of amalgamations are, so in the first category, there are amalgamations where there is genuine pooling, not merely of the assets or liabilities of the amalgamating companies, but also of the shareholders' interests and of the businesses of these companies. Such amalgamations are amalgamations which are in the nature of the merger. In the second category are those which are in effect of mode by which one company acquires another company, and as a consequence, the shareholders of the company which is acquired normally do not continue to have a proportionate share in the equity of the combined company, or the business of the company which is acquired is not intended to be continued. So such amalgamations are called in the nature of a purchase. So the main accounting procedures for amalgamations are pooling of interests method and the purchase method. So under the pooling of interests method, the assets, liabilities, and reserves of the transferor company are recorded by the transferee company at their existing carrying amounts. Under the purchase method, the transferee company accounts for the amalgamation either by incorporating the assets and liabilities at their existing carrying amounts or by allocating the consideration of the individual identifiable assets and liabilities of the transferor company on basis of their fair value at the date of amalgamation. The identifiable assets and liabilities may include assets and liabilities not recorded in the financial statements of the transferor company. In India, the merger and acquisition of companies is governed by the Companies Act 2013, which I have mentioned before, and the rules and regulations issued thereunder. Section 230 to Section 232 of the Companies Act 2013 deals with the provision for amalgamation of company. The process of amalgamation typically requires the following steps to be followed. First, the board meeting. The board of directors of the merging companies must approve the amalgamation and authorize their respective companies' management to take the necessary steps for the merger. Second, the shareholders meeting. The shareholders of the merging companies must approve the amalgamation by passing a special resolution in a general meeting. Filing with the registrar of companies. The merging companies must file the necessary documents, including the special resolution and the amalgamation agreement, with the ROC. Fourth, approval from the National Company Law Tribunal. The NCLT must approve the amalgamation after considering the report of the ROC and any objections or representations made by any of the stakeholders. Fifth is filing with the stock exchanges. The companies must file a copy of the order of the National Company Law Tribunal with the stock exchanges where the shares of the companies are listed. Sixth is obtaining necessary approval. The company must also obtain any other necessary approval from the RBI, the SEBI, and other relevant authorities before going forward. It is also important to note that the process of amalgamation can take several months and also require the service of legal and financial professionals. Another important thing to be noted is that the central government may prescribe conditions for the amalgamation of companies in public interest, and the same should be fulfilled. So, one such example of an amalgamation is the merger of public sector banks, which is the Allahabad Bank and the Indian Bank, which was announced in 2019 and completed in 2020. The merger was intended to improve the financial health and competitiveness of two banks, as well as to increase their ability to serve customers and support economic growth. The merger also aimed to achieve cost savings and synergies through the consolidation of operations and shared services. The merger created a bank with a strong regional and national presence, with a total business of over rupees 8.08 lakh crore and a network of over 3,000 branches spread across the country. This process is followed when the merger involves restructuration of capital of the transferor company or the alteration of the rights of the shareholder of the transferor companies. So the merger of Allahabad Bank process by which two separate banks are combined into one entity, which is governed by the Companies Act of 2013, which lays out the legal framework for such consideration. The Companies Act 2013 provides for merger and acquisition by following the process of scheme of amalgamation or arrangement. So the scheme of amalgamation is a process in which two or more companies merge into one, with the surviving company being the transferee company and the merged company being the transferor company. In this process, the shareholders of the transferor company become shareholder of the transferee company in the same proportion as the shareholding in the transferor company. The scheme of arrangement is a process in which the shareholders of the transferor company and the transferee company approve the arrangement, and the arrangement is then sanctioned by the courts. In the merger of these two banks, the scheme of amalgamation was approved by shareholders of both the banks and then by board of directors of the banks. The scheme was then submitted to the Reserve Bank of India and the Ministry of Finance for their approval. After obtaining all the necessary approval, the merger was implemented and the two banks became into one entity, which is now called the Indian Bank. In India, according to the section 44A of the Banking Regulation Act 1949, no banking company can merge with another banking company unless a scheme of outlining the terms of the merger has been presented in draft form to the shareholders of each relevant banking company separately and approved by a resolution of majority passed by the shareholders of both the companies. So prior to the shareholders' approval, the board of directors of the two banking companies must accept the draft scheme. The following factors must be taken into account while considering such approval: the value of the proposed company's assets, liabilities, and reserves, and if the proposed incorporation will result in increase of the asset value. The type of compensation the merging banking company will provide to the shareholders of the merged company, whether the required amount of due diligence has been done with regard to the proposed merger, whether the swap ratio that has been determined by the independent valuers and whether such a swap ratio is fair and appropriate. The shareholding structure of the two banking companies, and if as a result of the merger and swap ratio, any persons or entities or groups ownership of shares in the merged banking company will violate RBI's policies. The planned modification of to the board of directors composition and whether resulting membership to the board would be in compliance with the RBI's guidelines. And last, the impact on the viability and the capital adequacy ratio of the amalgamating banking company. If such a scheme is adopted by the required number of shareholders, it must then be presented to the RBI for approval, which, if granted, will be binding on the relevant banking companies. Along with the application of scheme of amalgamation, following are the few documents or informations which are required to be submitted. Draft scheme of amalgamation, which is approved by shareholders of both companies, certificates authorized by each of the officials present at the meeting of shareholders, certificates from concerned authorities of banking companies listing the name of shareholders who gave written notice to the banking company at or before the meeting that they opposed the amalgamation plan along with the amount of shares held by each shareholder. Details of the proposed CEO of the new banking company after amalgamation, annual reports of each of the banking company for the last 3 financial years from the date of the amalgamation. Such other information, such as documents or explanations as asked by the RBI during the process, need to be submitted for further confirmation. So, to conclude, amalgamation is a process which is governed by the law and is a very tedious process. It may require a lot of finance and legal help, which can then be completed properly and in time. So, thank you so much. And I hope you had received good information regarding amalgamation of companies.